And now we'll start having sales at places where we didn't need to have sales before. But despite the fact that this year, I think in general, will be slower than last year, we actually are situated so that I would expect, and believe me, when I say expect, it's nothing is sure. Nothing's sure tomorrow, nothing's sure next year, and nothing is ever sure, either in markets or in business forecasts or anything else. And we don't pay much attention to markets or forecasts unless the markets happen to offer something interesting to do. But nevertheless, we are positioned in two respects, as you'll see from this first report. Our investment income is going to be a lot larger this year than last year, and that's built in. I mean, we had, as you'll see in a minute, we've had 125 billion or so in very short-term investments, and believe it or not that long ago, we were getting 4 basis points, which is next to nothing, on that 125 billion, which means we were getting 50 million a year. And now the same money, just day before yesterday, we actually bought, because of some funny twist in the market because of doubts about the deficit ceiling or the debt ceiling, we bought 3 billion of bills at a 5.90. That's 5.9. It's a 5.92 bond equivalent yield. So we will have what produced us not that long ago on a 12-month basis was producing 50 million a year, producing something in the area of 5 billion a year. So we're in a position where the investment income is essentially, well, it is certain to increase quite a bit. And insurance underwriting is not, it does not correlate with business activity. It depends on things like hurricanes and earthquakes and other events. So on a prospective basis, on a probability basis, we're likely to have a better year this year in insurance underwriting than we had last year. It just isn't affected by what you might call the business cycle or what applies to generally in industry, retailing, you name it. So I would expect in one massive earthquake or one hurricane that came in at just the wrong place can affect that prediction. But on a probabilistic basis, our insurance looks better this year. So if you get two of the elements there of our main elements of earnings that look like they will swing in our direction, I would expect, but I can't promise, that our operating earnings will be greater than last year. And if we'll move to the second slide, I give you those operating earnings figures just to give you an overview of what has happened since the pandemic started and off the year before as a base. And we retain all our earnings, as you know. So if we're retaining 30 or 35 billion or whatever it may be a year, you should expect more operating earnings over time. I mean, this number should be significantly higher 5 or 10 or 15 years from now because we have the advantage of retaining earnings. And that's what got us to these figures, because they were essentially nothing when we started. And they got there by retaining earnings, and we'll keep retaining earnings. So it's no great triumph if these numbers move up. And what we hope is that they move up at a reasonable rate. Historically, they moved up at an unreasonable rate sometimes, but we were working with much smaller sums then, and that can't be repeated with our present capital base. Because I note there, I believe it's on this slide. Let's take a look. Now that'll be let's see, it's on the next place.